The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. We're getting ready to start the show. At the break, I'm going to post a website where you can go to get the book by Al Larson called Your Electric Life. Al is probably one of the smartest people I've ever met. He's certainly in the top 3 or 4 of all the people I've ever met. And contrary to popular belief, I was not living during the time of Pythagoras in 600 BC. He was by far the sharpest of all the folks. However, I do want to post that into the Tiger TV so that you folks that are listening can go in there and look at the archive and go in and pull out the book. He gives it to people free. It's basically a book that explains his explanation of what lunar tides and the lunar cycles mean to the human body, as far as the fact that we're 85% water, 15% elements, and it's a really good description, I think, of what it's really all about. And whether you believe it or not, I don't know. But the price of the book is great. I'll give it a money-back guarantee to anybody that doesn't like it. And since it's free, I don't have very much exposure at that end. I want to talk about the markets because we have made new highs in the NASDAQ. We have made new highs in the Russell. The Russell is also extending out and making a 1.61 ABCD expansion, much like it did in October of 2007. And the NASDAQ making a new high doesn't upset me that much either, but it's a smaller index. But the main one that I posted into Tiger TV and I'm watching the closest is the New York Stock Exchange Index. As you can see, we're right up against the 786 retracement from the high that we made back in A to the low down into June 23rd, and then the big rally, up into this past few weeks. The thing that's troubling to me, and that is the fact that we have made new highs in the NASDAQ, and we made new highs in the Russell, and we are almost making a double top in the Dow Jones. And it might not even be a double top. It might even keep going, and also in the S&P. If this fails, given where the Bradley model has done thus far, the fact that it had the high very, very spot on, and then we had the big break to the 61% retracement into June 23rd, and then go up and to make new highs, there's a possibility that this 5-wave reverse pattern that I've been looking at on the long-term chart of these stocks in the U.S. is wrong. And we could have a run maybe like what we had in 1999 and 2000. I don't know. I do know that the longer-term chart, is still going to be bearish unless we literally, explode to the upside, get above, 15,800 in the Dow, something like that, and above 1,700 in the S&P. Then I would have to say that, I've done something, well, I do something wrong a lot, but I would really say that this is where, the pedal hits the metal and, would have to be looking at much higher prices. But right now we're seeing divergences enough that I think we have to give it a little bit more time. The things that I was looking at last week when we had the new moon that came in on Monday, that didn't work. On Tuesday we had the Venus-Uranus combus that usually has a very high degree of calling market turns. That didn't work. And so that means that something else is pulling it higher. And the Bradley model, said that the market should be going down, sharply for well over 14 months after we made that high in May. And here we're going back to test the high. Now, if this is just a test like it was in October of 2007, that will really mean something. But we have to wait and see. The key part to look at when you're watching these index charts is the fact that we've left huge gaps. Courtesy of the Federal Reserve Board's minutes that came out last week, where they said they were going to continue to QE3 forever, or something close to that, and that sent the markets, into a parabolic move to the upside, and we left huge gaps in the S&P Cash Index, the New York Stock Exchange Index, and the Dow Jones itself. The Dow Jones Index, it only trades during market hours. The futures actually don't have that gap, but the index itself certainly does. And these gaps are usually filled. There's only one gap on the Dow Jones that hasn't been filled since they started trading the Dow Jones, and that gap was in January of 1991 when we had the Desert Storm War, the 24-hour war that the Navy SEALs had spotted, and we were watching it on TV, getting a play-by-play description, and the market just literally exploded the next day, leaving the biggest gap it's ever left. I believe the market was up some ungodly number. I don't remember the percent, but it was huge. And it was coming from a level, a lot lower. We were down in that 2,900 level, as I recall. And I think it moved, like 8% in one day. I can't remember. I just remember that it was huge. We didn't have overnight trading then, so the gap that was there was prevalent everywhere. The next thing to mention about this is, if in fact we have made, I'm going to put the Dow Jones transportation chart into Tiger TV so you folks can take a look at that also. And I also need to put in the chart of the Dow Jones Utilities, because that's also one that I think is very important to look at as far as watching these charts the way we do, because the Dow Jones Utility is going far, it's just barely making a 50% retracement after we've had the big move from, we dropped, well over 15% in the Dow Jones Utilities during that time between May 24th and June 24th. So we'll see if this 50% retracement is going to hold it. That comes in around 500 in the Dow Jones Utility. So we're having some divergence across the board here, but the fact that the NASDAQ and the Russell 2000 were able to make a new high is a sign of warning. I started the newsletter this week about the words from the song by Jimmy Rogers from The Gambler. You got to know when to hold 'em and know when to fold 'em. And that's true, and that's for an old poker adage that, you've got to know when you've got good cards, and you've got to know when you've got bad cards. And, we might be playing with a bad deck here. So, excuse me, it was Kenny Rogers, not Jimmy Rogers. Jimmy Rogers from back in my era of Honeycomb. God, back when I was a kid, I can't remember. I remember listening to that when I was in high school. That was right after the radio was invented, because I remember Marconi coming and speaking at our high school when I was in high school back in the mid-'30s. Okay, we know that we have a potential divergence in the Dow Jones Utilities. We know we have a potential divergence in the Dow Jones Transportation, but this could all be wrong, because if we go exploding to this week to the upside, then that's it. The problem that I have is that I don't have anything astrological here to look at that there's any importance that I can see. There's a thing called a grand trine, but I don't look at those. That's where you have a whole bunch of planets coming together at different connections. Arch Crawford looks at that, and a few other astrologers do, but I'm more short-term oriented, so I like to look at the lunar cycles. And the lunar cycles work great a lot of the time, but the question is, it's a lot of the time. It doesn't work all of the time. If you get something that works 65% of the time, you've got a huge advantage, and it certainly is able to, do that, but, it's not anywhere near perfection, and that's what the problem is. Someone emailed me something over the weekend and asked me, after looking at this astrology stuff for 40 years, had I found the secret to the lunar cycles, and I never have. I think God has a secret, but she's not telling anyone. And I just don't know what it is, because sometimes it'll work perfectly for 3 or 4 months, as we've seen before. And then all of a sudden it'll just go unruly. It was working really good during May through June. And as a matter of fact, we had the low come in on the full moon of June 24th, and we had a really strong rally that exceeded way past the new moon. So the only other astro event lunar-wise that's coming up is it will be the next full moon, which will come in around the 23rd of July. So that's quite a ways away. We're talking another 8 or 9 days. So that's what I see in the market. And if we get above 15,600 in the Dow, I'm going to have to say that, this is not working. This is a pattern that is breaking. However, if, it does turn from in that area, much like it did in October of 2007, if you remember back in those days, we made a slightly higher high in the Dow Jones and a few of the other indices, and then we just rolled over and came down very, very sharply. And if that happens, we're going to see it, and we'll know what to do. But there's also the possibility that we have a market like we had in 1999. I mean, that was a different type of market because I believe that was a once in a generation, because we had so many things that were telling us that you'll never see this again in your lifetime, is because of these stocks that went from $3 to $300 or $400 and then back to zero. And we're not in that type of era anymore. We're in an area where the Federal Reserve is, basically giving the market a big boost. The Gartleys that we have on the international markets are all still in place. They haven't, violated anything. The FTSE, the DAX, the French market, the Asian markets, the Chinese market, all of them are still in bear markets and have not violated anything. It's just the U.S. markets and the NASDAQ and the Russell small cap that is doing this. And whether it was done because of what happened on that Fed day by using that big, using that huge gap that we have or not, I don't really know. But because it goes there, you have to really respect it. That's why I'm saying that if this is wrong, it's going to be really wrong, and that's what we have to look at. So it'll give us plenty of time. If we're doing, the bullish consensus, the number of bulls versus the number of bears, is still very heavily weighted to the bullish side of the market, and that's the main thing that people have to realize, that these bulls can be right for a considerable length of time. If you remember 1999, the market went up from January through March, with just almost like a rocket. And then, on March 24th, it dropped and, gave back 85% of everything that it made over the past 5 years. We're pretty much at the same level that we were in 2007. So over the last 6 years, stocks have basically, gone nowhere. And, we've had a, move down in bonds now, where bonds are starting to roll over, and we think that's going to be a big move to the downside. The $64 question is whether we're going to have much of a rally in the bond market or not, which we will cover when we get back. But I did want to go over some of these charts, to alert you to the fact that I could be, really wrong in this, and that the Bradley market will be wrong, and that five-wave reverse pattern, which is the highest probability of any pattern that Gartley did, works. We're going to post that email for you, and we'll be back in a few minutes.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. With over 3 decades of commodity trading experience, Andy Hecht has developed a system that combines both technicals and fundamentals. He calls this approach Technomental, and now you can put it to work for yourself with his brand new service, the Technomental Commodity Report. In this weekly newsletter, which comes out each Thursday morning, Andy gives you his analysis of the market price direction bias using fundamentals, and then specific trade recommendations including entry and exit points using technicals. The recommendations in the newsletter are always based on stocks and ETFs, so a futures account is not required, and Andy will often use options in the recommendations as well. Andy will tell you where to get in, where to get out, and he'll outline the risk-reward profile for all recommendations. To get your month-long free trial to the Technomental Commodity Report by Andy Hecht while locking in the low introductory rate, visit the front page of TFNN.com today.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back, and I posted into Tiger TV the website to go to get Al Larson's book, Your Electric Life, that explains in his way of looking at things, how the Luna things affect the markets and how they affect us. Al has a double PhD. He has a PhD in computer science, and he also has a PhD in neural networks. He worked most of his career for American Telephone and Telegraph, setting up some of their more sophisticated communication systems. And then later, as he reached his in his 50s, about 20 years ago, he became really interested in trading, and that's when I met him about 25 years ago. And he is really a brilliant fellow. I mean, he has an education that is second to none, and plus he is a nice fellow, and he's very, very humble. He's one of the people that says never confuse your net worth with your self-worth, and he's a really nice fellow. So we want to do that. Now I've also posted into the Tiger TV, along with the website to get the book. I posted the Russell 2000 index, showing you that we're going up into new high ground. We're making a 1.618 expansion of the last swing. You know, we haven't done that in either we're not even close in any of the other indices except except we're looking at the Excuse me 1 second. I have to do a little technical thing here with the microphone, otherwise I'm going to be in big trouble. There, I think I got it fixed. Okay, now we were talking about the fact that the other indices have not made new highs, whereas we've done that in the Nasdaq and also in the Russell. In October of 2007, the Bradley model was off by more than a month, and it turned around and then started down. So you could always wait until the market turns down from here, if it does. And like I say, when I'm wrong, I've got to get off the pony, because it just doesn't make the thing work the way that you the way that you want it to do. So I'm going to try to repost another chart. Evidently, I'm having some technical problems with the charts, and I'm trying to get them into Tiger TV, because when I talk about them, I like to be able to put them in so that the folks can, see what I'm, looking at, what we're watching. Okay, now the next thing we want to talk about is the Treasury bond market, because we have been, talking about this market for a great deal of time, and I believe it's reached a level where we have made some real serious damage as far as a technical basis. We've held up at the 786, the 61% retracement of the last move that occurred several weeks ago, and as long as that move stays above the the 132 level in the Treasury bonds, I think we have a chance for the bonds to rally a few more points. But if by any chance that we do not hold that level in the Treasury bonds, then we're going to be looking at a market that is going to break down very hard, much like gold did, once that it gave up the ghost around the level of, the 1365 level in gold. But, 1565 level, because when we broke 1565, that was the last support level, going below the 786 of the previous swing, and then we cascaded to the downside, and that's what led to our move down to the 1170 in gold. But that's gold. Now we're talking about the bonds and the notes. Both bonds and notes held up exactly where they should have held. The notes went exactly to the 61% retracement on the long-term weekly cycle. The Treasury bonds went to the exact 618 on the long-term weekly cycle. And these are the lows from January of 2011. So you're going back 2 years. So they went back and they touched the lows that we made 2 years ago. Now, this is a large ABCD pattern that usually means the market has a potential to rally quite a bit. The last time we had an ABCD move in the Treasury bonds, they rallied a total of 10 points. That's a lot. It's $10,000 in Treasury bonds. So we could easily get a move from 132 to 142, and that would be nothing more than a 61% retracement coming off the highs we made in April. So this is what we would, like to see, is if we can get a nice chart. Well, I'm going to put the chart for Treasury bonds into the room, and you'll be able to take a look at it.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, I'm going to shift gears here a little bit and go over to Asia, to the Japanese market, and show the relationship between the Nikkei Dow and then also the Japanese currency, the dollar versus the yen. And as you can see, if you take a look at the chart in the Tiger TV, you'll notice that the red line is the actual dollar versus the yen. That's the currency itself. And the green line is the actual Nikkei Dow versus the currency itself. And as you can see, the correlation is about 95%. It's just a little below 95%, the correlation. And if you look at the chart closely, I mean, it just jumps out at you, the head and shoulders pattern that has completed these past couple of weeks. And, as long as we do not exceed, 14,600 in the Nikkei, and as long as we don't go above 104 in the currency, the dollar versus the yen is trading at 99 and change right now, then that tells us that, we're looking at it. Remember, folks, if you go back to June and July and October of last year, Tom O'Brien was talking about the King dollar and the fact that the support that we had in the Japanese yen was, tremendous, and that, it was going to go a long way. And, of course, that's exactly what happened. That 135 pattern is a pattern that was made popular by Roy Longstreet of Clayton Brokerage back in the 50s and 60s out of St. Louis, Missouri. And it is a very powerful pattern because you're looking at higher bottoms, which is a definition of a trend. And if you have the lower tops with the 135 pattern, you're looking at a downtrend. The pattern that we're looking at here, though, in the Nikkei Dow, is we're looking at the pattern that shows a head and shoulders pattern at that particular spot, and that's why it's so interesting. Now, what we really want to do, to get a little bit closer to what the market is doing, if we would take the time to look at the Nikkei Dow on the weekly basis. This is going back to 2007, and if you'll notice, if you look at the chart, you'll see in 2007 we had the big butterfly pattern forming, and we also made the double top, much like we're doing in the NASDAQ now and also in the Russell. We made a slightly higher high into late July of 2007, and then the market gave up well over half its value. Actually gave up 2/3 of its value in the Nikkei. We gave up a little bit more than half, I believe, in our market. But what's interesting is the high we made back, just a few weeks ago, it was early May in the Nikkei, was an exact 786 retracement to almost the exact high at 15,900 and change, and then we made that twice in 2 weeks. Each week had the same high, and then of course the market gave back 20% of its value, 22% of its value very, very quickly, and now we've had the 61% rally back that has formed the head and shoulders pattern, on the daily basis. So it appears that you want to be short, long the dollar versus the yen, and then also to be short the Nikkei based on the patterns, that we're seeing here right now. So we're seeing this all across Asia. China is a disaster. If you look at any of the Chinese stock market indices, it doesn't make any difference. You can pick any ETF that you like, or Shanghai, any of them. They've been in a bear market since 2006. And, they were the ones that were supposed to, take us out of the big problems that we've had. And, in fact, they haven't helped. The only thing that's helped is the fact that the Federal Reserve has opened the windows and given everybody except us, of course, the amount of money that they need to keep the, the business going. So it doesn't make any difference what people think. If the Fed is going to, to pump money in it, and people are perceiving that this is going to keep the stock market up, that could happen, for a considerable length of time, I suppose. Because this is experimental, what the Fed is doing, folks. I mean, they've never done anything like this before. If they did, we never would have had recessions during the 50s or 60s or 70s or 80s or 90s. We had one in 2008 and 2009, but that was caused, by the credit default swaps and the mortgage collapse and all this stuff. But now they're telling us that the real estate market is, back to where it was in 2005 and 2006, and I'm sure in certain parts of the country that is the case. But that doesn't mean that there's a lot of people that are not, still not hurting. So anyway, that's what we're looking at that particular spot right now. The bond market, we've talked about that already, and I certainly believe that I shouldn't say believe. I'm certainly expecting that we would get a little bit more of a rally here in bonds up to that 140 to 142 level. That would be such an ideal level. But the fact that this pattern that we've had in the notes, that head and shoulders pattern that we had, those are just really, extremely, tremendously bearish, longer term. We have interest rates higher than they were a year and a half ago, which is the first time that's happened in 32 years. So something's different has occurred. Now, the Federal Reserve says that doesn't mean anything, but, there's some dissension among the Federal Reserve folks, and so that's telling us that, maybe things in Camelot are not what we're assuming they are. Now, the next market that I wanted to talk about is one that's very dear to us because we like gold and silver a great deal, and we need to talk about this because I believe we are in a corrective phase to the downside in gold from what we're looking at right now. On just looking at the 15-minute chart, which gives us enough data through the low that we made back on June 27th, and that was the 618 on the weekly chart at $1,177 an ounce. We've rallied $125 an ounce in the last several weeks, and now we're in the midst of a correction. The last correction that we had took the market down $50 from the high that we made at the 1260 level. We came down to the 1212 level, which was a 61% retracement. And should we have the analysis correct on this one, we would expect the same type of same type of a correction to occur somewhere around the area of 1240 in the gold. So that would be the ideal place to look at it. If we do get the 1240 level in the gold, that would complete the 135 pattern that we just talked about, that Roy Longstreet was so enamored with. And believe me, Roy was a fabulous trader who left an incredible estate. And I knew Roy, of course, but I knew his son Bill much better. And they've done extremely well in the business. They're both since passed away, but it was a fun time to know them. Back in the early days of my career. The 135 pattern that we're talking about on the gold is the low from June the 27th, and then the low from July the 5th, and then we would be expecting the next low. It should occur within the next 4 trading days. In other words, we'd be expecting gold to drop about $40 from where we are right now in the next 4 or 5 trading days. If, in fact, we are correct on this, that we'll get one more correction before we get a better move to the upside. I'm of the belief that the bottom that we made down on the 27th of June at 1170 per ounce is going to be a very important bottom where we should get a rally of at least $300. There were so many people that are bearish there, and nobody likes the gold or silver anymore. That ought to tell us that you just should be a buyer anyway. So we want to look at these retracements, to try to get long, because everybody has, turned around and has made, gold a wicked stepsister, of the commodity markets, and yet, we did hold at very, very important support, but whether it holds or not, therein lies the $64 question. Part of this argument that we have with gold and also with crude oil and some of these things is the fact that deflation is a negative thing, and I don't know whether it is or not. We have had very little deflation, over the years. What's really funny in my career is the fact that, back in the 80s when I was at Drexel, interest rates were 13%, inflation was 14 or 15%, and I'm talking interest rates on T-bills was 13%. So you can imagine what junk bonds and some of the others were yielding. They were yielding in the area of 20, 25%. Muni bonds were 16%, and those were tax-free. And at the 50% tax bracket, that was a 32% return on investment. The problem was that the bonds that you bought, and I did buy some, they were called away in about 3 years because the interest rate started to drop, and it was cheaper for them to buy the paper back and call the bonds in. So if you had uncallable bonds, that was much better. Okay, getting back to the gold and silver and inflation, that's an argument that I look at the charts, I look at the CRB index, and I look at the DBA and these others, and we are in a deflationary environment for commodities. There's no question about that. The grains are still high. Soybeans are still in the teens. That's an incredible price. Corn is still at $6 a bushel. That's an incredible price, and wheat is still very strong. So those are incredible prices. But and cattle are still strong. I mean, they're quite a ways from their all-time highs, but they're still very, very expensive. And crude oil's back to the 786 of the high we made 3 years ago. Not the high we made back in 07, but that 107 in crude oil is a big number up there. And unless we can close above 108 very, very quickly, I think the crude oil is getting ready to have a pretty good correction, very similar to what I'm expecting in the gold market, to see if it'll come down another $40 into that 12.42 per ounce level in the gold, and then we'll be looking at something that I think would be better than what we'd be looking for in general. So we've covered the gold. Silver I'm not going to go into because I haven't had it. Well, I haven't had any requests for it, and it's much less liquid than the gold, and it's harder to trade because of the fact that it has less liquidity, and just gold is so much easier to trade that it's just really a whole lot better than anything else. Now, one of my reasons for being negative, the markets, as you know, is the price of copper. And, we have had an incredible move in copper to the downside and in stocks to the upside. But we've got a caller in. This is good. We've got a caller in from Dan in New Jersey. Dan, are you there?
I am. Thank you.
What can I do for you, my friend?
Well, sir, I was trying to get some insight as to what you're taking. I know you're looking at the 135 pattern on the S&Ps, but how would you know when we get out of, if you pull up a monthly chart? I'm trying to compare your 135 pattern versus a breakout of a, 12 or 14 year consolidation.
Yes.
Also, I'm sorry, and what would be confirmation that the breakout of the trading range is a false break topside?
You mean, in other words, that it would actually be a big failure?
Yes.
Okay. If you'll give me 1 second here, I have to refresh my data because, believe it or not, I don't look at monthly charts, very often. But I will draw this one in for you, and I'll show you that it's really hasn't really affected anything on the long-term on this 135 pattern. In fact, the fact that the market is made or really close to the new high hasn't affected it very much at all. I'm going to post that into Tiger TV now so that you can see it, and that will give you a pretty good indication of where we are. And if you'll take a look at it, you'll see that we've made a monthly high higher than we did in 2007, which you're supposed to do with that reverse point wave. And this is one of the most bearish patterns that you can get, and you're seeing it across the globe. You're seeing it in, all these stocks all across Europe, not Asia because they're going down, but all the others are making the same pattern. Does that make sense?
Yeah, absolutely. But the only thing I just wanted to get your take.
Oh, you want to know when I'm wrong?
No, not at all.
Oh, well,
I want to know when I'm wrong.
Oh, we've got a break here. Could you hold on with us, Dan, and then we'll be right back?
Thank you.
Okay.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Dan, are you still there? I guess I lost him.
No, I'm here.
Oh, good. I'm sorry. I turned off the mic. I have got allergies, and I started sneezing, and I turned off the mic, and then when I got back on, I forgot to turn the mic on. Believe it or not, I'm not a professional radio broadcaster, being the understatement of the year. But go ahead. Did I answer your question?
About the 135, yes. And okay. What I was looking at, though, is whether there's a trading range between 800 to about 1550 on the S&P, and if you were to figure that to be a rectangle trading pattern or consolidation or channel, however you want to, or primary trading range, however you want to look at that, the break above the 1550, I'm just trying to determine if on a rectangle pattern or trading range, since that break above 1550 is now going to take us to the upside for that 700-point range up to like 2400 on the S&P. Or conversely, what's going to or what would we need to see to show that that's a false breakout?
I personally, what I would be looking for would be a technical indicator like a really severe drop in the market, some type of an outlier event that would occur, maybe it could be a geophysical event like a earthquake or some type of catastrophe that changes things. Could happen from Japan or foreign. It could happen here, something like that, or something economical. That they find out that there's no gold in Fort Knox or something like that. Something really crazy, an outlier event that would change the way people think. In other words, they call it the change in economic thought. Yeah, that was a term that Paul Samuelson used during the 60s when he won the Nobel Prize in economics. And it would take something like that to do that. But the pattern that I'm looking at as far as that long-term expanding triangle pattern, that's what I think we're looking at. I don't think it's a rectangle. I believe it's that expanding five-wave triangle is what we're looking at.
Okay. All right, so let me just, if I could just put one last question. If we close any time over the next, I guess, by the end of the month or end of the month is certainly the widest band that you could ever ask for. Okay, and then what number would you confirm that we're in the in the triangle, like 1550 or below 1600?
Below 16. Anything below 1600 it has to be anything below 1620 would actually do it for me. Because that's a low we made just recently. That would tell us that everything is back in vogue. Would be below the 786. So thank you for calling in, and I appreciate the call.
Thank you.
Live every day in an attitude of gratitude, and may God bless.
Nowhere, spelled N-O-W-H-E-R-E. At one point, we've all been there, whether it be our health, career, or our finances. Some might be there right now. So where are you when it comes to your trading and investing? Better yet, where would you like to be? The good news, I can take you from nowhere to now here right now. Same letters, N-O-W-H-E-R-E, just a totally different emphasis and focus. Hi, I'm Steve Rhodes with TFNN, and on July 25th at 6:30 p.m., I'm going to share with you a trading strategy that I began on May 10th when the S&P was at 1627 and closed at the same price 8 weeks later. That's right, the S&P went nowhere versus a trading strategy that produced a 100% hypothetical return in that same period of time, and it's now here for you. Subscribers to my daily newsletter service, Mastering Probability, have free access to this exciting live workshop. The trend is your friend. All the details are on the homepage of TFNN.com. Decisions shape your destiny, and your trading destiny is now here for you.